Hello, and thanks for tuning in to another MarketMinder Minute. Media hysteria over the now 5-year Greek debt crisis has subsided in recent weeks following the country's bailout agreement with European creditors, a tentative bailout agreement. But the deal is fragile, and given Greece's shaky political situation and spotty track record of implementing reforms, there is still a chance Greece will leave the Eurozone. Many fear this will spell trouble for stocks, but in our view, fears of a Grexit is just another brick in the wall of worry that bull markets love to climb. It just doesn't have the power to wallop the bull market for several reasons. To start, markets have been pricing in Greece and its woes for years, and it just doesn't have the power to spook markets for very long anymore. For example, Greek woes have been in the headlines since 2009, yet global markets are up over 190% since then. Another factor is diminished contagion risk. Greece's bond yields, a reflection of its creditworthiness, soared in late June and early July as bailout talks collapsed. Greek banks closed and the government missed an IMF debt payment. Bond yields for other peripheral Eurozone countries remained relatively stable, though, rising just a bit. They traded like the Eurozone core, not Greece. Likewise, the risk of financial system contagion has diminished. Today, Greek debt is primarily held by government entities and bailout mechanisms. International banks have steadily decreased their exposure to Greek debt since 2009. If other Eurozone government shares of Greek debt run right now just around 2% of their respective GDPs, so if Greece defaults again, their losses should be much more manageable today. Greece's size or lack thereof when compared to the global economy is another factor. In our view, Greece is simply too small to derail global economic growth. It represents just 0.3% of the close to $80 trillion world economy. Now, that might be difficult to scale, so let's look at it another way. If Greece were a U.S. city, its $200 billion GDP would make it about the 15th largest metro in the U.S., about $13 billion behind Detroit, the same Detroit that declared bankruptcy in 2013, which was a fantastic year for stocks, in fact. In our view, Greece's economy remains too small, their assets too narrowly held, and the global economy too strong for another default or even a Grexit to derail this bull market. Heck, we think a Grexit would be bullish. Kicking the can down the road perpetually keeps the false fear alive, and this weighs on sentiment. If Greece actually left the euro, this false fear would be finally exposed as investors saw firsthand that trouble didn't spread. Folks could finally get over it and continue climbing the wall of worry with one less fear weighing them down. Now, we can't forecast if Greece does leave the euro, but stocks would probably be happy if they'd just get on with it. That's all for this edition of the MarketMinder Minute. Thanks for watching.